Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Welcome. We're here September 1, 2025, Labor Day. World-renowned econ professor Edwin T. Burton. Professor, welcome back. Classes are back at the University of Virginia?
They are. They started last week. We're going to begin the second week tomorrow.
Professor, everybody's talking about the Federal Reserve meets September 17th. The federal funds target rate, currently at 4.25 to 4.50. What will the Federal Reserve do on September 17th? The U.S. two-month Treasury sits today 4.24%. U.S. 10-year Treasury today 4.23%. U.S. three-month Treasury 4.15%. What will the Federal Reserve do on September 17th?
Well, they always enclose the new target range around the 2 and 3 month Treasury bill yields. So given where the yields are, they're going to come down 25 basis points to 4 to a quarter, 4 to 4.25.
And will that change if the yield on the 2 months rises? Will they have to reconsider?
They would, there's no question, but it would have to rise a lot. It would have to not just rise above 4.25, but rise to 4.30 or 4.35. Because if it just rose to 4.25, they could easily do a reverse repo facility and effectively buy Treasury bills and force that yield back down if they wanted to. But I don't think they're going to have to do that. The bill market is, there have only been a couple of Treasury bills yielding above 4.25 over the last few months, and now they've come in to well under 4.25. And as long as they're close to that number, they'll go ahead and act because they can. What most people think the Fed can do, they can't do. A lot of people think, including economists, that the Fed can just announce a new target range and that's that. Well, it doesn't work like that. The Fed can announce a new target range, but unless the rest of the market is already in that range, which it already is right now, then it won't be effective. They would have to use their balance sheet to force it there. It's like saying, I want the price of oil to be $55 a barrel. Well, it's not just going to magically go to $55 a barrel. You're going to have to sell a lot of oil, a lot, to get it to go to $55 a barrel. And the same thing's true here. The Federal Reserve has much less power than is commonly believed. Now, it does have a power that it could use, but it's reluctant to do that. It could come in and buy $2 or $3 trillion worth of Treasury bills and move the yield wherever they wanted. They have an unlimited ability to print money. But the Fed is not stupid. They know if they print trillions of dollars to buy Treasury bills and force yields lower, they know if they do something like that, there would be inflation. Now, they never talk about the money supply and inflation, but they're not stupid. They know that if they rapidly expand the money supply, they're going to get inflation. They know that. So they generally won't do anything unless the bill yields are where they belong. And based on where the bill yields, if the Fed just went to sleep on September 17th, they will move the new target range to 4 to 4.25.
President Trump is asserting expansive powers to fire Fed Governor Lisa Cook. Should the Fed be independent?
Well, that is a very interesting question because I think the answer in economics may be different than the answer in politics. The Federal Reserve has never been treated by any presidents as totally independent. That's never been the way any president has looked at the Federal Reserve. Presidents have always leaned on the Federal Reserve to do what they want. There's absolutely no question about that. Trump is leaning on them hard, but Biden leaned on them very hard in the last administration. So much so that when asked about the spending that took place in the beginning of the Biden administration, Powell suggested it wouldn't have any real impact on anything and gave his blessing to the most massive spending that the country has ever seen in such a short period of time. And according to Powell, it was not going to be inflationary or anything else. That clearly was a political statement, not an economic statement. And we saw what happened. You had a lot of inflation afterwards, which they should have known. I certainly knew it. I posted an article in the National Review in March of 2020. At the time Biden was proposing all the spending, that it would be very inflationary if they did it. But the Fed was on the other side on that one. Now they say they don't have an opinion about anything. They no longer have any opinion about things like, are tariffs a good idea, and blah, blah, blah. You wonder why. So the Fed has acted for really since the early 70s, like to some extent it's beholden to whoever happens to be in the White House, and sometimes they bow to congressional pressure. So it's not unusual for the Fed to look at that because politically, what branch of the government is the central bank? It's not part of Congress. It's not part of the legislature. So it must be part of the executive. And if it's part of the executive, then it's not really truly independent any more than any of the so-called independent agencies are truly independent. And we're seeing the courts rule that way. In the last 2 or 3 years, the courts have declared a lot of so-called independent agencies not truly independent. It's hard to see how they can be independent because if they're independent, that means no one controls them. So if you get the wrong guy in as, say, head of the Fed, and they're truly independent, then if they do really dumb things, they can't be removed or stopped. So they're not truly independent politically or from a government standpoint as far as one can see. But it would be good if they were. It would be good policy if they were. It's not clear how you enshrine independence into the Federal Reserve. But it's a good thing for the central banks, even if they behave foolishly, to be independent. And why is that? Because if they're not independent, then you're going to have the Turkey situation, where Erdogan, the president of Turkey, forced his central bank to dramatically increase the money supply in order to lower interest rates, and the result was massive inflation. They finally pushed the inflation rate all the way down to 70%, which is considered something of a victory in Turkey. And that's what would happen, because what do politicians want? Well, if you're in office and you look at your central bank, you want lower interest rates. That's what you always want. I've never met the politician that didn't. Show me the politician that says, let's raise interest rates. So the pressure is always on the central bank, no matter who's in the White House, to lower rates. And if you have to use the balance sheet to do that, inflation is going to be the result. Now, the one episode where you did not get inflation is a very interesting episode. It's the period from 2009 to 2019. And what is the most likely explanation for what happened there? People have wondered for a long time, well, wait a minute, didn't the central bank increase the money supply a lot? And it did. It increased it at about a rate of 7% a year, per year, over those 10 years. And yet inflation remained subdued at 1.5% to 2%. And interest rates were very low, staying under 3% most of that period. So why were interest rates so low for so long? What happened there? Well, I think one simple explanation is the balance of payments deficit. When you run big balance of payments deficits, what happens is dollars pile up all over the world in China and Japan and whoever's running surpluses against you. And they buy your treasury bills, which keeps rates low. And so the massive increase in spending by foreign countries on U.S. treasury bills, I think, had a lot to do with the very low rates we experienced in 2009 to 19. You just had an extra factor in the market that largely isn't there anymore. The Chinese and Japanese, there's still some buying, particularly by China, very little by Japan now. So the foreign buyers have pulled back a little bit from some of what they've done. There have been other buyers to replace them, but still, it's not the same as it was in the 2009 to 19 period. So should the Fed be independent? The answer is it should be independent. It's better for the country if it's independent, because if it's independent, it will resist the demand to lower interest rates. If it's not independent, it will not be able to resist it, and you'll have a flood of money and, predictably, quite a bit of inflation. Countries that don't have independent central banks have a lot of inflation.
Where do you think the economy is today? Do we have inflation? And can you speak to the U.S. equity market? In terms of multiples, the U.S. equities are higher than they were back in the dot-com bubble. Can you please speak to the economy?
Yeah, let me go after both. The first is the economy. You can read all the macro models, and they're all pretty bad at predicting things. And really, the only thing you really want to predict are turns. The only thing interesting is, when does the economy go from being a growing economy to a weakened economy, and when does it go the other way? When does a weak economy become a stronger economy? And I think there are only two variables you need to keep a close eye on, and they're big ones. The biggest is consumption. Watch the trends in consumption spending. Now, that one has been trending down. The growth in consumption spending was running about 2.5% per year if you go back about 9 months ago, and now it's moving toward 1% a year, which is a pretty dramatic fall off in consumption spending growth. So what's the other one? The other one is plant and equipment spending or investment spending generally. That one's held up, although it bounces around a lot. If you look at the monthly data, for example, January was a negative number, and February was a massively large number. So the accident of when months begin and end seems to affect the data. But broadly, investment spending has not tailed off yet. And it's held up by the spending that's going on in the artificial intelligence boom in two ways. One is the AI spending that's being done on software as firms like Meta and Microsoft and Google and Apple and all the rest of them try to expand their capabilities in artificial intelligence. It's also booming in data center. People are building data centers all over the country because large language models require an enormous amount of data. By the way, also computing power. One guess, by the way, about that is I think the real threat to the AI activity is not so much that someone's going to build a big capable model and swamp everybody else. I don't think that's where this is going. I think a better analogy is the car industry. Everyone thinks they're going to build the next Porsche or Mercedes, but really it's probably going to be the next Ford or Chevrolet to take the AI winner. You don't really need necessarily for most applications the best AI model. You might prefer to buy one that's selling at a price 1/10 of the best model. That might be good enough to get you from point A to point B. And I think that's the real competition, and that's the threat to NVIDIA. By the way, NVIDIA may have the best chip out there, but most companies may not need the best chip, just like you don't need necessarily the Porsche to get yourself from home to the office. The Honda might do the trick just as well, and the Honda's a lot cheaper. And I think you're already seeing that in AI. DeepSeek, the Chinese model, was built a fraction of the cost that ChatGPT, OpenAI's version of the large language model. So I think that's the real threat to the AI capital boom, frankly, is that cheaper models are going to work. They're not going to cost as much to bring along. So what does that mean about the valuations? Well, the earnings of all these companies, you constantly hear Wall Street people say, well, the earnings are still growing. These are real earnings that Meta and Google and Microsoft are all making. Well, they are as long as you treat all the capital expenditures as capital expenditures. But if some part of them are expenses, then earnings are falling pretty dramatically. If you just take Meta, for example, which had $35 billion in earnings in the first quarter this year, they had $40 billion in capital expenditures on AI. That's 35 minus 40 comes up to me to be minus 5. So if that's all expensed, and I'm not saying it should all be expensed, but probably a good part of it should be expensed. Because a lot of these companies are playing defense with artificial intelligence. They're not dying. Look at Apple. Apple's trying to stay away from it. They're not dying to spend a lot of money and use up all their available cash competing in the AI space. Some of them don't even want to do that. But if you say that, you're not viewed as the next best thing. So some of the AI spending, I think, is clearly defensive. And AI itself is beginning to run into some issues. I don't know if you saw Taco Bell recently talking about the problems they've been having. They put AI in their drive-in windows, and they had videos showing people drive in and, I'd like a ginger ale, please. And then the AI would say, what drink order would you like to go with that? And kept repeating that request. Then somebody drove into one and said, I'd like 10,000 glasses of water, and the whole AI system just kind of broke down. So Taco Bell is in big retreat right now, pulling all those AI things. They had been 500 stores, if you can imagine. And that's the problem. Any of you who ever have to deal with technology today, and you have an exception, you already know what I'm talking about. You can't get a representative on the telephone so you can have some human to talk to. when something goes haywire and some technology thing you're dealing with, AI's got a lot of that. It makes a lot of mistakes. Here's an interesting twist. There's a story recently about AI in the medical area that a doctor using AI turned out to do better diagnoses than he would without it. But once he'd been using it and he was left to do his own diagnosis without AI, he had actually gotten worse. In other words, once he got used to AI, it helped him. But once he set it aside briefly, he began to make a lot of errors that he used to not make before he found AI. So there's a lot going on there. This is not as it was described by Sam Altman just 3 weeks ago. It's like having a PhD level consultant by your side. No, it's more like having an undergraduate who occasionally has hangovers by your side. They're good when they don't have the hangovers. But when they have the hangovers, which are called hallucinations in that industry, then you're in trouble. Then you get a wrong answer. They invent some answer. You describe somebody, who is this person? And then they give you somebody that never lived. That's very common with large language models in the AI world. So all is not perfect there. It's not the end-all, be-all, and maybe it can beat somebody at chess or something. But in the real world, we're not playing chess. We're making tough decisions about life and death in a lot of situations, or about our future or how that's going to proceed. So I think there's a lot there. My guess is the stock market is seriously overvalued, at least those tech stocks are. There are a lot of stocks that are actually down on the year. Small stock index, for example, is negative this year since the first of the year. So there are a lot of stocks probably people should be buying, but the ones that have been propelling the market are just a handful of tech stocks, and I think their day is numbered. But don't rush to take action on that, because that may happen 2 years from now after they're twice as expensive as they are today. Rallies based on nothing have a way of continuing way beyond the ability of people to take advantage of selling them.
How about inflation, Professor? Do you see inflation in the U.S. economy?
Well, assuming the central bank pursues the current path of the money supply, which is pretty slow, it's running at about 2% a year. And I think the inflation battle that stemmed from pandemic spending, both 2020 under the Trump administration and 2021 under the Biden administration, the excessive money growth that caused that inflation, I think that's kind of over. I think the price level has risen enough. The money supply increased 50%. The price level's up about 35 to 40%. The inflation level, I think, would peter out here over the next 6 months, 12 months. And there wouldn't be any reason for the Federal Reserve to be worried about it. I don't think the tariffs' main impact is to spur inflation. The tariffs' main impact is to weaken the economy. It's a sales tax. It's a sales tax. And so some prices will go up, but the weakness in the economy will bring other prices down. And overall, I wouldn't think the tariffs would change the inflation pattern, but they would make us all poorer. They've already made a lot of people poorer, by the way. And I think that will continue. I think the damage done by the tariffs is ahead of us, not behind us. And they will continue to have a damaging effect. But it's more the weakening of the economy instead of inflation that concerns me. Now, if, on the other hand, the president takes over the central bank and says, lower these rates, I want 1% rates, that's what he said not long ago. The only way to get that is to increase the money supply enormously, and then you'll have a resurgence. So if the Fed independence disappears and the central bank starts on a path to lower rates more than the market would like them to do, they'll have to use the balance sheet to do that. There is no way. You can't just magically wave a wand and say, let there be a 1% overnight interest rate. It will not happen. You have to actually enter the market, buy securities, and force it down there. That would be inflationary. And I think that's a real danger. There's good and bad in all this in so many different ways. You think of the situation of trying to remove Lisa Cook. Looking at her resume, it's not clear why she was ever appointed or confirmed in the first place. She's done no research on macro and inflation. She has really no earthly idea or didn't know before she got there, or at least it wasn't clear she knew what the Federal Reserve really did. Instead of appointing someone who was an expert on money and banking and what the Fed does, they appointed Lisa Cook, who, she does great research in a different topic, but none on things that matter there. So she should never have been appointed in the first place. But that does not mean it makes sense to single her out and go after her. So we'll see what the courts think about mortgage applications and all that. If she did make fraudulent mortgage applications, then she should be removed for cause. But it's not clear that she did that. We don't know yet. And there is an aura of selective enforcement here that is troublesome about the Trump administration. They're not broadly going after people who lie on their mortgage applications. They're picking out Lisa Cook and putting her under the microscope. And that's probably not a good thing. If they were going after everybody, that'd be different. But to single out a single Fed member because you're trying to get control of the Fed, that's kind of what happened, really, in a sense, to Trump himself during the Biden administration, where he ended up in a court situation because, according to the government, he lied on a loan application. This was a loan that was approved by a major bank and by commercial lenders, and it was a loan that had been paid off. So there weren't any victims of his crime. And that's not necessarily true in Lisa Cook's case, because she got a favorable rate that she wouldn't have gotten, and somebody else might have gotten that favorable rate instead of her, if the allegations are correct. I don't know if they are or aren't, and that's up to the courts to decide. But the whole thing is troublesome. It does look like selective enforcement of the law, regardless of how the Lisa Cook thing comes out.
U.S. debt is $37 trillion, shortly be $40 trillion. U.S. federal government receipts is a little less than $5 trillion. The Besant Plan, 333 plan, calls for growing our way out of the deficit. Can we do that?
No, you can't grow out of it. First of all, the growth rate in the U.S. is way too low. It's hovering around 2%. You can't grow your way out of anything at 2%. But the Secretary of the Treasury, he's a nice man and a very smart man and a very honorable man, but I think he's dead wrong about virtually everything he says. Tariffs are not a good idea. I know I've said this trillions of times in these podcasts. Because a blanket tax like that, and particularly where they're used, 50% tax on this, 25% tax on that, it's like the president wakes up every morning and decides what tax policy to pursue and changes it all the time. You can't run a tariff policy like that. It's destabilizing. It's going to shift a lot of trade away from us. You can see in these meetings that are taking place right now with China and India and Russia and other countries that they're trying to move away from the U.S. as a trading bloc. I don't think long run they'll be successful at that. The U.S. economy is the best market economy in the world, certainly better market economy than any of those economies. But still, I think the president is damaging us by these policies. I'm sure he has the best of intentions, but good intentions don't necessarily always lead to good policy. The best tariff for America, with some small exceptions for national defense, the best tariffs are zero tariffs. That would be best for the American consumer and best for the world. And if you don't want to balance a payments deficit, raise the domestic savings rate. The reason we have a balance of payments deficit is we don't save enough. So when you're trading with countries with big savings rates and you have a little bitty savings rate, you end up importing savings, and that's what we've been doing. And it's been helpful. It's kept our rates low. It's kept prices of things we buy low. It's really worked for us. We've been the winners, not China. China's managed to develop. That helps them. But the real winner has been the American consumer for the last 20 years. There's no question about that. We're a much richer country today than we were, say, 2 decades ago when this all started. But, it's funny. It's often the worst enemy you have is that look in the mirror and look at that person in the mirror, and that's the enemy. And to some extent, that's America's problem. We've caused the debt problem that we have. And now we're going to have a day of reckoning, and it's not far down the road here. The Social Security is running out of money. Medicare and Medicaid are running out of money. And interest rates aren't, as Janet Yellen predicted, and aren't so low that we can just do whatever we want. Let me quote Janet Yellen in the first year of the Biden administration. Let's go big. Well, that's what they did. That turned out to be a colossal mistake. We shouldn't have gone big then, and now we're paying the price. And now there aren't a whole lot of avenues of escape here that are going to be easy. There are going to be some tough decisions need to be made down the road, and they're just going to be made in the next 5 or 10 years. We're not talking 30 years down the road. We're talking 5 or 10 years down the road.
What do you think about the Warren Buffett solution to the debt? He stated that we can solve the deficit overnight by stating that no congressman can stand for re-election if the U.S. annual debt exceeds 3% of GDP.
Buffett has never been known to be wrong, and he's probably right. I think I would agree with Buffett.
Professor, big couple of weeks on the bond market, short end. We should all watch the 2-month Treasury. Let's talk soon, September 17th, big date. Professor, thank you.
Thank you, Hunter. Enjoyed it.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.